Okay, so good evening, everyone. Welcome to today's session on quantitative finance. Myself, Shubham Agrawal. I am doing BTech right now in second year from IIT Jodhpur. I'm studying from the Quantitative Finance Cohort 2024, and we are thrilled to have Mr. Santhosh with us today, an expert in quantitative trading who will talk us through Python backtesting for futures trading strategies. He will cover key topics such as margin requirements, daily settlements, and how to evaluate strategies using historical data to ensure reliability and performance. So, without further ado, let's dive straight into in. Please join me in welcoming Mr. Santhosh. Hello, Santhosh. Over to
Uh,
you,
Hi,
sir.
Shubham. Uh,
Yeah.
so I'll share my screen now.
Yes, you can start.
Uh, so so today's session is on futures backtesting in Python. So I'll give a brief intro about myself. I did my BTech in mechanical engineering from IIT Jodhpur in 2018. Soon after I joined TVS Motors as a mechatronics engineer. There I pursued MTech in data science and engineering from BETS Pilani, and from there I moved on to a quant role in Axis Investment Private Limited, which is a family fund management company. So I'll start with a session. So before moving on into the backtesting part, I'll give a brief intro refresher on futures. So what are futures? Futures are a financial instrument that allow a trader to buy or sell an asset at a predetermined date in the future at a predetermined price. Okay. So the underlying asset can be a commodity, index, single stock, or a currency. So there are two types of position you can hold in a futures market. One is a long position and a short position. A long position is a contract to buy in the future at the entry future price, and short position is a contract to sell in the future uh, at the current future price. So why do we do futures trading? Is because the trades are leveraged. Uh, this is because the broker offers a margin to the trader, which is a fraction of a cost compared to the future price. Uh, and uh, 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 and one of the key features of the future contracts is the returns are highly correlated with the underlying asset. So when you want to make speculative or hedging positions in uh, hedging positions in the underlying asset, it is feasible to do it with the help of a futures contract. For example, if you want to speculate on the price of crude oil, it is it is the only way to speculate on it is using either futures on the is buying holding a long position on the futures on the crude oil contracts, or through options on the same, because you can't hold a physical copy like a physical you can't buy gallons of crude oil and hold it and sell it at a later price unless you have the capacity to do so. uh, uh, so so now I will move on to margin requirements. The role that the brokerage plays in this is like um, mostly like brokerage and the exchange is uh, when a trader enters a long position for a particular price, it matches him with a opposite position holder in the market for the same quantity. So to enter any position, you don't have to have the you don't have to deposit the entire entire forward uh, price worth. to enter the position. Brokerages usually offer like a margin requirement, which is significantly less compared to the forward price. Say ES is currently trading at $6,000. E-mini futures are trading at $6,000 and a multiplier of 50. So like each contract is worth around $300,000, but you don't need to have $300,000 in your margin account to enter a ES E-mini futures. The margin requirement is really is only 8% of the uh, 8% of the spot price. That is, you just like the futures price. So you need only $24,000 to enter the position, but it does come with a catch, though. Okay, so there's a concept called daily settlement. Every day at the end of the close, so this 24,000 is like a collateral for a loan you take, collateral for the loan you take to enter the position, kind of. Uh, uh, so there's a concept called daily settlement. So where to avoid default. Okay, so at the close of every day, uh, at the close at the close of every day, mm, the brokerage, say a long position holder makes a profit of $100. The brokerage literally transfers $100 from the margin account of a short seller to the long seller, the matched seller. So the long seller, he can use the additional $100 as he pleases. He can literally transfer it to his own account. He can enter additional position with the $100 and so on. But on the other hand, the short seller, his margin balance has reduced. It has reduced from, it was say 24,000, it has become 23,900. Uh, so to avoid the default risk, the position holders are required to maintain a minimum margin uh, minimum margin balance. Okay, so uh, required to maintain a required to minimum margin balance. Uh, 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 in order to avoid credit risk. So in case it is usually some 50% of the initial margin. So as I said, say 24,000 was the initial margin. It is usually some 50%, which is $12,000. If your margin balance goes below $12,000, the broker will intimate you to top up it back to $24,000. Uh, if you have enough cash, you have to add $12,000 back to your margin account. Else, by the end of the day, he will close the position. So it is a major risk because you may enter at the worst point in the trade. So it is it is important to simulate this margin call in order to check if we are breaching the margin calls. So rollover and packages prices. So I'll show you the CME's E-mini futures calendar. So, futures are not continuous contracts. You have a rolling contract. So, for example, if you can see, ESH 25 trades between 16th December 2022 to March 2025. It's usually the case where the current contract month will have the highest liquidity. Because people like because they it is due to the psychology of the people. So uh, uh, they and so and we want to invest where there is highest liquidity, because there tends to be more slippage when there isn't much liquidity. And so, but there is a case. This is 21st March 2025, right? So close to 21st March 2025, the liquidity of ESH25 will reduce drastically. This is because uh, this is because close actual speculators and arbitrages will leave this contract and will move on to this contract, because this is close to expiry, and holders with this contract will have to accept physical delivery. That is like if you hold ESH25 close to 21st March 2025 for say crude oil contract, and at some at $3,000, you would have to buy. You would literally have to buy the barrels of crude oil and store it somewhere. So which is not ideal. Uh, so uh, so usually when you hold long-term positions in futures contract, you roll over to the upcoming futures contract. So, but during back testing, it is very hard to keep track of contract wise prices. So what we do is we back adjust the prices and stitch them together in order to account the cost of rollover. So I'll show you the ES E-mini futures futures prices. If you see uh, uh, every there's a arrow, right? These arrows represent the rollover. So it rolled over from ESU 2023 to Z 2023, and it is usually much before the actual expiry date, some 1 week or 2 weeks before. For different futures, different roller buffer is there. And if you see, there's a adjust. It's like there's a back adjust prices. Whenever we do back testing, we we back adjust the prices and simulate all of them in order to account the cost of rollovers. S- so with this, we'll move on to the Python backtesting. Backtesting. So to backtest, I'm intending on using a very simple strategy. So it is a very simple strategy. It exploits momentum in the future. So like when price hits a new high, we enter a long position. When price hits a new low, we exit long position. Okay. Uh, so uh, so first I'll explain the uh, code for the strategy. So the strategy is very less. So we take the arguments close prices, the window, like the high of like how many days are we considering, the low of how many days we are considering, the max concurrent contracts we are going to hold, and are we allowing short? Okay. So the short part I'll come to it later. So so on each day we find the high of the uh, past window days, and we check if we have attained a new high. If it is a new high, we and our position is less than the max current concurrent positions we can hold, we'll enter a new position. So so we keep track of number of contracts we hold on that day. We can so this is like a substitute for signals, and it is convenient in for my back tester. That's why I'm holding storing it as an array of position sizes. So and so similarly, I check if the if we are making lowest low, if it is a lowest low, we exit the long condition. Uh, and simply uh, we just set the current position to 0, and we set all positions afterward to be 0. So with that, we got the signals for the turtle strategy. Now yeah, Hali, you have a doubt, Zulfikar Ali?
You can speak, Zulfikar, if you have any question. If no, then Santosh, you can continue.
Yeah, sure. So I'll proceed with a backtester. Yeah, Suruchi.
Yes, sir. Could you please increase the size of the code as it's not much visible?
Yeah. Is this fine now?
Yes, it's better now.
Do I need to revisit the strategies part?
Could you like rephrase what we have done till now in like concise way, please?
Yeah. So we had a refresher on the margin requirements for futures contracts, and to backtest it, we are using a very simple strategy called turtle trading strategy. So where we enter a long position when we hit a new high, and we exit the long position when we hit a new low. So since the major emphasis on the backtesting part, I've chosen a very simple strategy. So the strategy position sizing is so
Kindly, can you zoom it further?
yeah.
Thank you.
Okay. So yeah. So uh, the total strategy. So we check every day. We check if we hit a new high. If we hit a new high, we enter an additional contract until we hit the max concurrent contracts we can hold. And when we hit a new low, we exit out of the current long position. Okay. So I'll move on to the backtester. So for the backtester, I've designed it as uh, so defined it as uh, so in order to backtest the futures contract, I have basically defined two classes. This class will handle the margin requirement part, and it'll open new trades, it'll close the trades, uh, uh, it'll check the margin requirements, it'll do margin, if there is a margin call, it'll intimate the researcher, and based on the position side, it'll enter new positions, and finally it will evaluate what is the current portfolio of this. And this class is basically to store the current open positions in the single open position in the trade. So like say we entered a long position, then it'll store where in at which index we like index represents a bar in the price. So since we are using daily bars now, this represents a day. Uh, the uh, the quantity we entered, the entry price, the direction, is it long or short, the entry commission which we paid, the initial margin, as I said, that we deposit to the uh, that we deposited to the broker, and the current margin is kind of a representative of margin balance. This is I will explain further. It is not exactly margin balance, but this is very useful in calculating the margin balance. Uh, uh, Calculating the margin balance, yeah. So the entry time and the exit time. Okay, so I'll uh, explain through the code how our back testing happens. Okay, so I've this is the back testing code actually. This calls the futures portfolio and this trade class to simulate the back test. So the we give it the arguments we give it are the position size, which we derived from the strategies. Our strategy. This is this way we can test multiple codes. It is not this if we can include this code here also, but this will make it less modular. So you can test multiple strategies by keeping this as a modular part of the code. The OHLC prices, the timestamps of each OHLC bar, and this timestamp usually points to the start of the bar, and the initial capital which we are allocating. So the margin required to enter a position. So this is a ratio. It is like, yeah, as I said, like it was 0.08 for E mini features, right? So like yeah, basically that, and the maintenance margin, it is again a ratio. It is for E-mini features, like usually it depends on the brokerage also. Some brokerages allow extremely low maintenance margin, but it eventually leads to a higher margin, like a higher leverage actually. So usually, yeah. So it is roughly say 50% of the 50 to 60%, I would say, of the initial margin. And slippage. It's like slippage. I would explain it as uh, so. Say if you would be you'd be aware of the bid offer spread, right? So usually we assume that uh, there is like two types of slippage. One is latency based slippage. That is basically say your system latencies causes a delay in the trade, and the market has moved to some point, and you are placing a trade there. And second type of slippage is the bid offer spread slippage. So like even you have zero latency, you will still incur some slippage because there is a spread between the bid and ask prices. Okay, so the next is the multiplier. So multiplier is simple. It is for each point in the E-mini futures represents $50. So that is basically it. And default quantity is whenever we get a signal, how many contracts are we going to enter? So that is it. So to back test it, so if you see, we basically we iterate through all the days. For each day, so we first initiate this class with the initial capital, the margin, maintenance margin ratio, slippage, multiplier, and default quantity. Okay, and so the futures portfolio, when it get initiated, uh, it uh, it uh, it'll keep track of the current balance cash it has, the current open positions it has, the closed trades, and the current position. Okay, So usually like yeah, the current position we started at 0, unless we want to like do a walk forward test where we will get the open position from previous back test and put give it as an input to the upcoming back test. Okay, so yeah, so we set the current position, and so uh, so 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 after initiating the portfolio class, uh, uh, we first call the update portfolio class. We'll see what we do here. So okay, so so if there is a change in the position size, then we need to take additional trades or close existing positions to match the position size which we derived using this strategies. So we in the update portfolio we got the current price of the futures price, the position, the target position, the timestamp at which the timestamp at which we are placing we are updating the portfolio. So as long as basically we are checking if we want to buy or if we want to sell. The position is greater than the current position, we have to buy additional contracts, and if the contract is less than the current position, we have to sell it, right? So uh, so so if we have existing positions, okay, so if we already have if we so we do it in a while loop until the position becomes equal to the current position. Okay, so basically so if we have current open positions, okay, uh, uh, say if the current open positions are short positions, we have to close them. If they are long positions, we have to take a new trade. Yeah. So basically I'm just checking that. So if my current open position is a long position, I have to take an additional trade. If it is a short position, I don't have to take additional trade. I have to close the trade. Okay. So if it is if it is a long if it is a sell order, if it is a short position, and if it is a sell order, I have to take a new trade. Otherwise, I have to close the existing trade. So this flag encapsulates this. You can, if you have any doubts, you can interrupt me. So basically, so once I get to know that I have to take a new trade. So I have a method called open trade. Here, here basically I call the execution price. So execution price uh, includes the slippage uh, which I mentioned earlier. So if it is a buy price, you'll execute at a higher price. If it is sell price, you'll execute at a lower price. So you got the buy price, and you're updating the position. Okay, so you'll calculate the quantity you can buy. Okay, so here where the margin requirements come into play. So margin requirements is basically so to enter the full contract, you need buy price into per contract. This is margin required per contract. So this is buy price into multiplier is the entire worth, but the brokerage requires only a fraction of it, which is denoted by this self dot margin. So the maximum quantity we can enter is this the current cash we hold by the margin required. and margin required per contract, and we will enter the default quantity. This is so that say you have uh, so you need a so margin required, say $1,000, $1,000. Your default quantity is 2. And your cash balance is say 1,050. Okay, you will so you got a signal, so you will at least partially fill the order. So you will instead of buying 2 contracts, you will buy 1 contract. This is basically for that actually. Okay, so so you calculated the buy quantity. So due to this reason, so you will not you can't you won't enter if here itself the quantity cash is less than the margin required, you will get 0 quantity, and you may not able to fulfill the order. Okay, so basically so I check if I can enter a position by simply checking if the buy quantity is greater than 0. If it is greater than 0, I update my position. I subtract the commissions from the my cash. It is usually a fixed value per contract. Um, the so initial margin is as I said, like so buy price into margin into which we discussed earlier, and I create a trade object, and I push it into the my open positions. I subtract the initial margin and the commission from the cash. Okay, and I return 1 just to specify that there was a trade. Otherwise, it'll get stuck in the while loop actually. So so like if it is less than 0, I'll just break out because you can't take additional trades, and it'll get the position will never be equal to current position, and you will keep looping through the while loop. So so yeah, and so yeah, so if the alternate case where you want to enter a long position and your trades are already short, then you so you pop the oldest trade. So you close the oldest trade basically. Uh, uh, so and you close the trade. So what we do in the close trade is pretty simple actually. So we get the execution price using the same logic. We calculate the commission, and we use the current margin. Okay, so this I will explain soon. Okay, so why we add the current margin instead of the initial margin? This is because this is because of daily settlement. And again, so finally we add the PNL. PNL is if it is a long sell price minus entry price. If it is short, it is entry price minus sell price. So that is using this direction. And so finally we create a dictionary and push it to the closed trades list. Um, so and so if there are no trades, we open new trades. That's it. So this is this is it with the uh, like the update portfolio method. Now we move on to the get portfolio value. Here is where I handle margin requirements, daily settlements, etc. So I basically have a method called check margin. So where I loop through each open position. Okay. Okay. I loop through each open position. I calculate the maintenance margin, which is simply the initial margin. Yeah. Yeah, Suruchi.
Yes, sir. Sorry to interrupt, but I had two questions.
Mhm.
Will we be getting this code to experiment by ourselves?
I couldn't hear you. Can you repeat that?
Like, will we be getting this code to experiment and understand by ourselves later on?
Yeah, sure. Yeah, you can take. I'll give it to the organizer. Maybe he can share it with. Yeah.
Yes. And like, is this meeting is being recorded? Like, I might have to go somewhere else in the middle of the webinar. So, if I can visit the webinar again in some YouTube or other platform, if it's being recorded.
Yes, it's been recorded, Suruchi.
Yes,
It will
thank
be
you.
uploaded in YouTube also. You can watch it
Yes.
there.
Would you please share the code on the GitHub?
Uh, GitHub. Yeah, sure. Yeah. Yeah, I'll make a simple repo and I'll share the link. Yeah, with the
Yes,
organizer.
that
Yeah.
would be great. Thank
Yeah.
you.
Yeah. So yeah. Uh, and the thing is, so one of the thing you have to notice is this is actually a very simplistic code. This I have boiled down multiple features down to for the sake of readability and for the seminar. So you yourself should improve the code. Like you should for example. So I'm using position sizes, right? So this doesn't allow stop limit orders uh, because if the position say the position became one on a day, and there was a stop limit order and it became it exited on the same day, the position will be zero, and PNL, the loss or profit encountered by this intraday trade will not be reflected in this code. Okay, this is okay. Yes, this is mainly to get across the margin requirement state of the uh, 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 margin requirements. Yeah, 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 sure. Uh, yeah, sure.
Sorry, it was like by mistake
Yeah, sure.
or
Yeah,
something. Sorry.
yeah. So, yeah. So, yeah. Um so when you learn more about it, when you do your more experimentation, you can improve the code. Yeah, sure. I'll create a GitHub link and I'll share the code. So yeah, so we got the maintenance margin, which is simply initial margin into maintenance margin ratio, and uh, yeah, we need to calculate the margin balance, right? So we have another attribute. If you recall, I told you like this current margin. This value will keep updating to keep track of the daily settlements. Okay. So basically, what I do is every day so this is the like this is kind of a placeholder. Whenever we withdraw from it, we withdraw from this variable. Actually, this is like a phantom margin or something like that, a variable which keep tracks of if we had like if we top up to initial margin also, we'll add it here. If we this way we avoid the cumbersome step of like keeping track of we added this much on this day, and it is like a memoization in dynamic programming. Okay, so like yeah so so we uh, the current margin Yeah. So this variable, so we use it to, this is the P and, so given the price of the future is this much, the total PNL will encounter is this much. Okay. So when considering we already, this already includes, uh, this already includes the daily settlement values. This kind of represents the margin balance actually. So whenever the margin, so this variable represents the margin balance. So I'll write it here maybe. So okay, so when the margin balance falls below the maintenance margin, we'll top it up simply by like, if we have sufficient cash, okay, we top it up. We say self dot, so we remove the amount from the cash and we add it to the current margin, the variable which I told you. And if we don't have sufficient cash, then we close the position simply. The same thing, same code, the close trade, and I delete the position from the open trades. Yeah. So and finally excess margin, right? If the if the margin is, if the margin balance is greater than the initial margin, we add it to the cash and we remove it from the current margin. Yeah. Uh, s- so we did the margin handling there, and finally we have to evaluate what is our portfolio is worth. That is basically like the total cash you have, the total cash you will have had you exited out of all positions that you hold currently. Okay. So that is, this is basically just the close trades code. So but I don't pop out the, I don't remove the open trades. I just like estimate how much cash I will get if I kind of like virtually exit from the position, and that is my current portfolio. Okay, so that I store it in an array, and I can store the cash balance uh, cash balance in the portfolio. Yeah. So I'll do a so so here I'm basically importing the backtester from here, strategies from here. Uh, I'm uh, I'm reading the ES 1-day adjusted prices, E-mini futures, adjusted prices, getting the OHLC date time. I have data since 2016. Okay. I created the position sizes, gave these arguments. Okay. And uh, so I am simulating the backtest. And yeah, so this is the portfolio we got. The CAGR of 12.5 percentage. Yeah, and so these are the trades. So it's like so yeah. So we opened a position here, entry here, exit here, and stuff like that. Yeah. So I haven't prepared much material on optimization and like overfit test, underfit test, etc. So yeah, so yeah, so that's yeah. So if you have any doubts, I can explain further. Maybe I can even like debug. Yeah, 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 Suraj.
So what do we exactly mean when we are saying value of a portfolio?
So portfolio is basically like, yeah, so it is worth of the current position, yeah, basically. So say you have three long positions, okay, in your margin account, and you have a cash of 100 rupees, sorry, $100, then the current portfolio worth is basically what does the final cash will be if you closed out all three positions. Okay, so it is like if you sell that position, you will get the same value. Like that is the, yeah, yeah, Zulfika.
Can we show the output of this portfolio on any kind of user interface,
User interface meaning?
meaning just a kind of front page of the website?
Yeah, yeah, sure. So you have to develop a dashboard maybe. Yeah, yeah, yeah. Anyone else have a doubt? Yeah, Prithviraj.
So I just missed out on the point. What data was this like? कौन से index का data था ये?
Yeah, E-mini futures.
Sorry?
E-mini futures.
Okay, E-mini features. Okay.
Yeah.
And so like in other strategies, we use RSI and other technical indicators to get something out of it, like 14 days or 16, 20 days of
Mhm.
trading window period. So
Yeah,
you
yeah.
haven't used it anything over here. So like how it is different and how do you make it stand different from those strategies? Like what is the new thing that you tried to implement in this thing?
So yeah, today's session was not focused on a strategy development. Basically, this is a very simple strategy, as I said. This is like this is exploiting basically momentum actually. So you can, yeah, you can use some of those technical indicators. You can optimize them, and like this is a plug and play, right? You can basically write a strategy using RSI. Okay, using RSI, and you can generate a new position size, and then you can you can create a new signals and backtest it here. Yeah, yeah, Zulfikar.
Okay, I heard that there is a C++ language is considered to be more close to this quant finance.
Yeah.
But I don't disagree. I don't agree with that because nowadays Python is emerging a very popular language. So just getting the grip on Python, do you think we have a potential to grow in this market, computational finance, or you can say that we should also go for C++ as well?
So I would recommend getting knowledge on both actually. So based on the role you are going for also, like if you want to go into a like a research kind of role, then yeah, Python must be sufficient. But when you go into deployment, you need a low latency deployment. In those cases, you need to have knowledge of C++.
So how could we access the code like you just mentioned? You will be sharing the Google repo, sorry, GitHub repo link.
Yeah, yeah,
So
yeah. I'll create a
organize.
Yeah, I'll share it to Shubham Agarwal, and then yeah, you can share it. Uh,
Yes, I will share it in the group
yeah,
from where you join the session,
yeah.
or you will be mailed accordingly.
So I joined from the LinkedIn's that quantitative finance cohort वाला पेज पे कल आया
ओके,
था तब.
सो आपका मेल होगा ना, आपको मेल कर देंगे जो लिंक होगा, गिटहब लिंक.
ओके चलिए.
My one question is that suppose someone is experienced in this computational finance. Uh, I'm talking about that future trading and equity trading like that.
Mhm.
So, do you have some person to resolve the queries of that person, so that he should know what he else should learn uh, to enter in this market,
I
quantitative finance.
So yeah, there is no like yeah, you have to start the research on your own, I would guess. Like I don't know. Because yeah, because yeah. So as you read more about it, like when you start experimenting, you will start to know learn what are the things you need to learn automatically actually in this field. Yeah. Yeah.
So actually, I'm a BTech final year student with an interest in like quant and related fintech uh, department.
Hmm.
So I actually aim to become a quant researcher or a quant analyst. I
Hmm.
have been reading about things, and I was also trying to give that NISM equity derivatives exam, and I also have created this Bollinger Band trading strategy project,
Okay.
and I have also like in an internship worked on a chatbot based LLM based chatbot
Hmm.
that was taking like data, daily data
Hmm.
of like high end companies, and
Hmm.
it was being fetched about those data, and it was like a chatbot was like something we can ask daily what's the new update on the stock market, and it would tell us daily updates.
Hmm.
So, with this kind of background, how hard or easy would it be to actually get into a company? What should be the right approach to get into a company with such background? I wanted to know.
Uh, yeah, so your profile seems to be really good. Yeah, so if you're really passionate about it, you can take like you can pursue CFA maybe. CFA is your probability of getting controls significantly improves once you clear CFA level 2. Yeah. Uh,
Okay.
yeah.
Well, actually, the companies I contacted, all of them were saying they don't hire freshers basically. And
Mhm.
even if they are trying to hire freshers, they should be from IITs, otherwise, they don't consider them as people.
Uh, yeah, that may be true. You can pursue first a data science role, like you can a data science role and uh, like get to know the nuances of data science, like handling data and stuff, and then you can move on to confidence.
Yes.
Can you suggest some job relevant websites where we can get the know-how that what they require at different levels of job positions? What is the job description of?
I don't get the question.
I mean, so can you recommend some job place websites where we can get what kind of jobs are there and what are the description of those jobs, what they require from the candidate to apply on those jobs relevant to quantitative finance?
So yeah, you can yes search through LinkedIn, Naukri. Yeah, that's it. Yeah, and relevant roles are basically data science roles, and from there you can switch on to quant finance maybe.
Okay, thank you. And what about the role of econometrics?
I'm not sure about it. I don't know. I don't know. I don't know about much about it. Yeah. Uh,
Do anyone have any more questions? Uh, If no, I think Shantosh,
yeah,
uh, you want to say something
yeah,
at
that's
end?
yeah. It was a nice session. Thanks for being a wonderful audience. Yeah. I'll share the GitHub code to Shubham Agrawal today or
Yeah,
tomorrow. Yeah.
I will share it to all the ones. And thanks for joining. It
Yep.
was pleasure
Yep.
learning from you. Yeah, thank you so much.
And,
Then we can wrap up the session.
and I am also thankful to you guys and introducing and this wonderful cohort and webinar. Thank you so much.
Sure.